Welcome to the My Crypto Guru video number, 7 or 8, whatever it is. How to pay taxes in the United States. So specifically, obviously, this is for those who owe taxes in or to the United States of America. First off, I'm not an accountant. I'm not a financial advisor. I've gone through and I pulled all my own trusted sources together to try and give you a basic breakdown of how taxes work here. This is not a comprehensive guide, and it's not specific to your situation. My goal in this video is to give you an idea of how to put things together to hand it to an accountant. Stress, hand it to an accountant. Hand it to someone who understands how taxes work. The first year, 2017, is where most of you are paying your taxes on cryptocurrencies. This is not a year with all the Wild West stuff going on right now where you need to go screw around and try and save $200 by not getting an accountant. The U.S. government is not someone you don't want to pay. So get an accountant, learn from them how to do it, and then next year do it yourself. But this year, just trust me, you're much better off to spend a little extra money. So anyway, we're going to cover 4 topics here. Income tax and how it pertains to cryptos, capital gains, short and long term, and what those terms mean, an easy way to account for trades, and what do I do with hard forks like Bitcoin Cash and Bitcoin Gold? So let's get started. Cryptocurrencies are treated as property under the U.S. tax code, and therefore, in most cases, it's subject to capital gains. But let's talk about the one time where they are not treated as capital gains or losses. It's any situation in which your employer pays you in a cryptocurrency. So there's not a whole lot of those out there. Those of you who are doing it probably already know this, but just in case, if I pay you in cryptocurrencies, you have to claim that cryptocurrency as income, okay? And that is at the price that you received it at. So if I pay you a tenth of Bitcoin, and Bitcoin at the time is worth $10,000, I paid you $1,000 worth of Bitcoin, okay? You're required to claim $1,000 of income on your taxes. Whether you sold that Bitcoin or not, you're required to claim it as income on your taxes at the time you received it. Now, let's say you hold on to that Bitcoin and 6 months down the road, you sell it for $2,000, okay? Well, you've already claimed $1,000 as far as income that you received. Now you owe $1,000 on, well, you don't owe $1,000. You owe taxes on $1,000. That's the gain that you received from the $1,000 you received as income and the $2,000 that you sold it at, okay? Now, not many of you are going to have this problem. If you do, you can send us an email. We'll try and help you out, but you really need to talk to an accountant. If you're in that kind of situation, really in any of this situation, you need to talk to an accountant. Now, if your employer is paying you in Bitcoin, yes, they do owe Social Security, unemployment, and all other associated payroll taxes on you. Don't let them skirt that just because they're not paying you in US dollars. So now on to the more common question, trading. So we're going to talk mostly about 2017, but I want to touch on this subject as well. There's a rule that's going around that the IRS has had for as long as I know called the in-kind trade rule. This rule allows one with property to exchange it with other like property and not pay capital gains until the property is converted into dollars. Some people felt as though this rule applied to cryptos, so therefore any trade between two cryptos, so directly from Bitcoin to Litecoin, Litecoin to Ethereum and all that, you didn't owe taxes on those trades until those trades were actually converted into dollars at the very end. I can tell you that for 2017, there's a gray area there. Talk to your accountant. For 2018, the rule has been squashed. The IRS has come out very clearly that in-kind trade rules do not apply to anything after December 31st, 2017. So moving forward, you need to make sure that whatever you're using to account for all this accounts for the fact that every trade is taxed in 2018. Now, for the purpose of this video and for my own purposes, I have trades in cryptos as well. I am paying taxes on every trade in 2017 because quite frankly, that amount of money is not worth going up against the US government. So I'm paying taxes in 2017 on my trades, and for the purpose of this particular video, we are assuming that all trades are taxable events. Before we go any further though, and you go, okay, well, maybe there's a gray area. My crypto to crypto trades might not be taxable. You need to understand that if you use an exchange like Coinbase that does not allow crypto to crypto exchanges, straight from Bitcoin to Litecoin, Litecoin to Dogecoin, Dogecoin to Ethereum, you had to go from Bitcoin to dollars, dollars to Litecoin in order to make the Bitcoin to Litecoin trade. Those absolutely do not qualify for in-kind trade. No exceptions, no possibilities. And if you have over $20,000 in trades on Coinbase, they're reporting it to the IRS. They've already said that. So now let's go to the capital gains in general. There's as we said earlier, there's two kinds of capital gains, short-term and long-term. Short-term is any asset held less than a year. Long-term is any asset held longer than a year. They are taxed differently. At the end of this video, we're going to have all the charts for 2017 up, and you can just pause on them and get an idea of what kind of taxes you're going to pay based on your short or long-term capital gains, based on your married or single, and based on your income. So anyway, let's go to the first example. It's going to be pretty simple. You buy $1,000 worth of Bitcoin. 2 years later, you sell it in 2017, and you sell it for $2,000. You owe long-term capital gains on the $1,000 worth of gain. So $1,000 was your cost. You put that in. $1,000 was your gain. You gained that. It's long-term on that $1,000 in gain because you held Bitcoin for longer than a year before you sold it. So, second example, pretty simple as well. You buy $1,000 of Bitcoin, and less than a year later, you sell it in 2017 for $2,000. You owe short-term capital gains on $1,000. You held the asset less than a year and had $1,000 worth of gain. Simple, easy peasy. Now the complicated one. For simplicity, we're assuming all assets in this example are held under a year. With again, the assumption that if you held it longer than a year, you probably don't have a ton of trades to work through. So short-term trades, this example is primarily for you day traders out there. And this is for when you go from crypto to crypto. Again, we're assuming that crypto to crypto trades are taxable. So let's say on the dollar value, you buy $1,000 worth of Bitcoin and you trade it for $1,500 worth of Ethereum. Remember, we're just assuming all these trades are short-term. And then that Ethereum goes down to $1,200, and then you trade that $1,200 worth of Ethereum for Litecoin, and that Litecoin goes up to $1,800. And then you trade that Litecoin at $1,800 for $1,800 worth of Bitcoin. And then Bitcoin goes to $2,400, and you trade that $2,400 worth of Bitcoin for $2,400 worth of Dogecoin. You see how complicated this gets. And then Dogecoin goes down to $2,200, and you trade it for $2,200 worth of Bitcoin again, et cetera, et cetera, et cetera, et cetera. So it's all within a year. It's all short-term capital gains. But you go, oh man, I got to pay taxes on every single trade. How do I account for all these trades? Well, it's easy. You don't have to count for every trade. If you bought $1,000 worth of Bitcoin, and at the end of the year, your last trade was valued at $2,200, you pay short-term capital gains on $1,200, the difference between where you started versus where you are. Don't make it any more confusing than it needs to be. You gain $1,200 on trades, and the key is you just go back to the last trade. Now here's the nuance. Your value that you pay taxes on is not the value at the end of the year of your account. It is the value of the last trade in your account. So if you didn't trade anything November, December, you go back to whatever it was when you bought it back in October. It's the last trade that's in your account. Because your trade is a sell, and the selling point is next cost basis. Okay? So let's say we get a little more complicated. We go, I have all these things spread out. I bought $1,000 worth of Bitcoin, then I moved 500 of that to Ethereum, 200 to Litecoin, and 350 to Doge, and well, that's more than $1,000, but you get the idea. And 5,000 trades later, I have no idea what I have. Here's the thing though, you do. So you take your current holdings at the value they had the last trade. I don't care if there's 5 of them. I don't care if there's 200 of them. You take the value of them at the last trade. You look up the dollar value they were at the date of trade. You figure out how many coins you have. You figure out your cost basis, okay, or your value at the time that you bought them. And then you add that column up and you subtract it from the money you started with. Now, I'm not telling you you don't have to list every transaction with the IRS. I don't know if you do or not. This is where an accountant comes in. Again, this is just kind of a general idea of how to do things. You know, the accountant and your tax professional is going to know whether or not you need to list things specifically or what form to use and all this other stuff. Don't go screwing this up. This is the first year that a lot of people are reporting. It's just use somebody, okay? So, before we forget, so we talked about short and long-term capital gains. We talked about how to account for trades. And we talked about how income tax works with relation to crypto, which is self-explanatory. If it's income for you, it goes in the income tax category. So I forgot to mention, or almost forgot to mention, coin forks. So when you have hard forks like Bitcoin Cash or Bitcoin Gold, which we both had last year, how are they treated? Well, they're treated as income. So you pay taxes on your Bitcoin Cash or Bitcoin Gold that you received as if they were income. It's free money to you. You treat them, your cost basis, okay, the value in which you pay taxes on them, is based on the date that you received control of them. Now here's a little bit of a hair split. If you control your wallet and you did not go get your Bitcoin Cash for a month or two, it doesn't matter. You control the wallet. It was split off that wallet. Whether you personally went and got it or not, it doesn't matter. It's when you could have taken control. Now, the good side of that is if you had your coins in Coinbase, and Coinbase was keeping you from controlling because they didn't release Bitcoin Cash till January 1. Okay? If they kept you from accessing your Bitcoin Cash, then it's January 1. So you can't take the, I didn't import it into my wallet, so therefore it's not my problem. No, that's not it at all. You could have controlled them, you chose not to. With a third party like Coinbase, you couldn't have controlled them because they kept them from you. So if you're part of the Coinbase Bitcoin Cash crowd, you won't report your Bitcoin Cash as income until 2018, so you don't have to worry about this so much. So let's just go a quick example. So let's say you had control of your wallet and you owned 10 Bitcoin on August 1st when Bitcoin Cash was handed out. So as a result, you have to claim 10 Bitcoin Cash in your taxes as income. Now, the cost basis per coin is, at least the one most commonly thrown around, is $277. So in this example, if you own 10 Bitcoin, you would claim $2,770 in income on your taxes for 2017. This is whether you sold your Bitcoin Cash or not. And let's not forget Bitcoin Gold, which you also received if you held Bitcoin at the time of the split, which was October 25th of 2017. The cost basis commonly thrown around for that is $138.69. So again, if you had 10 Bitcoin, you would claim $1,386.90 on your taxes for income. Again, have an accountant look over these numbers. These are the numbers that I found based on what everyone's kind of thrown about. So, again, hopefully this video kind of finds you where you need to be. Gives you an idea of how to write things down for your accountant, because I know a lot of accountants are losing their damn minds over this. So, gives you an idea of kind of how to account for them, how to put things together. You can pull spreadsheets from different exchanges. I know Coinbase has it, Poloniex has it. You can pull things down from your exchanges and all that and kind of see where you're at. But don't get caught up in the actual like every little tick of a trade. If you just look and say, okay, well, I've gained X amount over my Y amount that I started with, I owe taxes on the X amount, and I think that'll get you where you need to be. But again, you can always go to My Crypto Guru on Facebook, join us on mycrypto.guru. Just come by, say hi, and we're here to help.